All righty. Good afternoon. We're here back again. Today is October the 1st, 2020, and we're going to continue with part two of understanding options. So, as you all know, my name is Roy Idrach. I'm a stock analyst, and I've been trading since 1972, so that makes it about 48 years of bad or good experience. That depends who you talk to. But here I am, we're still moving forward. So as you remember, we talked on part two about options, implied volatility, brokers taking advantage of the traders, and so on. So we go over with this one once more time very quickly. Remember that you can print that when we upload it to Facebook, and you can use it as a reference. Option writers have the advantage. If they have the stock, they got more advantage. Option buyers, it's a disadvantage. So the option writer or the option seller, cover call seller, are an advantage. The options are overinflated, and you're going to see why in a few seconds on the next slide. The value of the option don't match the price of the stock that it moved. We're going to see that too. And remember that the option time value eventually ends up at zero. So this is your like buying insurance on your car, $100 for 1 month. And at the end of the month, you have no accident. If you want to keep on having insurance, you have to pay again another $100. So option expire just like insurance in your car that have expiration date, and the other guy keep the money. So knowing that, and just for a quick refresh, let's move on. We visited this slide before where the guy buy an option for pay $500 for 100 shares, and at the middle of the game he find himself with $400 profit, but he was greedy and he worked on emotion. He was going to make more money, and gradually what happened is that the stock ended up at 45. That's what it was going to be anyway, but the option premium disappeared, became zero, and all he made probably about $390 after he paid the commissions. So now we get over here where we're talking about options and what it means. Normally, this is Facebook. This was made back on May 2020, but the action here is not when it was made, but for you to understand how option price is done. So here we look at it, and we notice that this is for 1 week, and then the following week going to be May 20 and the 29, and the following week is going to be June 5. So there's almost 3 weeks here. But what we're interested in the price and the strike price that we talk about it. So let's take the $230. If the stock is right now at 229, so 230 is out of the money. It's out of the money because the price has not reached that. If we go to 232 or 240, it's way out of the money, probably about $12. You notice that the options out of the money by $10, you can buy them for 66 cents. But if you're going to buy the 227, that is already $7 in the money, you can buy them for $4.19. Or the market maker here, that this is the bid and ask, $4.10 to $4.20. So what the market maker is telling us that he buys at $4.10 and he sells at $4.20. So he's making 10 cents on every share. The volume of the transaction during that day is 24,000, but the open interest is 3,329. Well, the open interest is not exactly that 3,329 contract. That is, one contract alone can have 100 contracts in it. This is just how many contracts are open, but it don't tell you how many contracts are in. That's just one individual like me. I might be there. I might be this number 9 in here. We was 28, now it's 29. and I count as one is I bought it all at that price, but I'm gonna have 40 contracts. So this number is not exactly the contracts. This is the amount of outstanding interest in there, and different guys have a different amount of contract. Now we go and talk about what we talked before, implied volatility. The market makers and the broker exaggerate that. It's inflated. What they're telling you is that Facebook can drop 44% from 229 based on the option, and that the option can also go up 44%. Well, it'd be very certain will happen. So we're talking about that the volatility, in order for the option to move that much, the price has to move that much too. This implied volatility demands higher prices. This is where you have these prices for this option here. On this side here is the delta. The delta is what you're going to get per dollar that the stock goes up if you happen to be at 230. So if you buy an option that the strike is at 230 and Facebook moves to 229, 230.41, this guy that owns the stock is going to gain $1, you're only going to gain 47 cents and a half. If you buy an option that is at 235, that the strike price $235, so now we're about $6 out of the money. It's going to cost you less, between $1.29 and $1.31, but for every dollar that the stock goes up, you only get 26 cents, 0.2634. So I talked about that before. So now you see how it works. This is in a weekly. Facebook got weekly options. So you take position on whatever. This is the put side. You're expecting the price of Facebook to go down. So therefore, this is the same thing, volume, bid, ask, and last. Don't make the mistake. You get a screen like this that you click over here when you want to make a call. When in reality you buying or you want to sell a call or buy a call, and you actually dealing on the put side. You actually either buying a put or selling a put. So they kind of balance. If you look at across to it, when a put, which is way below the 229, it got more value. But if we check here, 229, 221 for a put at 227, and we look at the call that is out of the money by one, it's about 285. So they're very close to the price. This is if the price go down. This is if the price goes up. This is the call side. So as you can see, this is what you normally see. Some options trade by the month, but the implied volatility that we talk about it, this one makes it the guy that buy the option to be at disadvantage. This one makes that the market maker, the broker get more money because they by implying volatility, that don't mean they're going to happen, that this price can change 44%, over here can change 53%, and you're being charged for that. So you really are at disadvantage. If some people don't agree with me, let it be, but I've been doing this for 48 years, and this is the way I look at it, and this is how I have made my money. Now, here's a new item. More simplicity. You get the stock price. It'll be on this side. This is the same thing we did over there before. The striking price was $40. The price went up to 45. At the time of the push of the option, it was at 35, and the guy decided that he was going to buy an option at 40 because it'd be cheaper than buying it at the money at 35. He paid his $500. This is how the premium upsets you. So this is your premium is $500 when you bought it, but we're going to divide it into 4 weeks so we can see what happened here. So a week later, the price haven't moved, so 5 days, here is Friday, and your option now worth $475. So you had lost only $25. We calculated a different, but we're going to end up at zero anyway. At the beginning of the following week, the stock start moving, and your option, if you bought it at 40, right? Because it's out of the money, your delta is 0.2452. That means that for every dollar this thing goes up, you're going to get $24 on your account for your option. However, you notice that at the same time, right, we expect the price of the option premium to go down. So you were $4.75, so now you're $4.50. So you make $24, but you already had lost what? You haven't made any money yet because now the option were $4.50. So you $50 from 500, you make 25, so $24. So you're still about $27 in the hole. The price started going up in 1 week, and it jumped up, it goes up $10. So now at the end of Friday, on the 12th, your option now worth $400 on the premium. You pay $500. This is what we're tracking over here. We got it. Now this, I'm sorry, this is the stock now is on the money by $500 on the option, right? It's on the money. It's already $5 above what your striking price. And now you delta of what you want to make per dollar have come up from 0.24 to 0.6737. Again, you're still in the hole, nothing has changed. And gradually, as time go by, we move into our third week, and now that the option was only $300, you're still at 0.6737 because the stock price had not moved any higher. So you cannot get, more because the price don't go up. So you don't making money. All you have made is a part. So we get over here to the third week, and now on Monday, it was $3,700. You still like that. You pay $500 for the premium, so you're down $200 over here, and you are $5 in the money. By the time we go over here, this is where you still have the $500 here. You're still $500. You still got $500, but this side, your option premium is eating away. So here we go at the end of the third week on the 19th, and this will happen. That was on June the 1st of 2020. So it's got exactly the amount of days that we needed, and it falls on the right weeks. So here we go, and then on Friday the 19th, we got $200 on the option premium. So we already had lost $300. So we got $500 here. So now 200 and 500, we got 700 altogether. But since the price had not moved, you keep on getting 0.67. Nothing has changed. All is happening is that the premium that you pay keep on going. On the last week, we don't have the curve here, but this is actually what happened. On the 22nd is the last week of trade, and Friday the 26th is the last day of trading. At the end of Friday, what's going to happen here that you got $500 in the money. You didn't change any, but your option now worth about 25 cents. So when you take the 25 cents and you got 25, your value is 67.37. So altogether, what you got here is $92. The seller who sold the option for $500 premium, he gets that. You call in the stock because in the money, he net $1,000, $5 that he was in the money, maybe he paid 35, and he probably get 40, so you get 500 on that. He was willing to sell it for 40, so all he can make is 500, but you give him 500 on the premium, so he netted $1,000. Meanwhile, you got two choices here. You buy the stock at $45 or sell the option and close the contract, and you end up with $407 loss and 63 cents. Remember that you pay 500, but you lose most of the value. And when we put the 25 cents and the 67 cents that you had made, the whole thing, you lost $92 on this part. Saturday, now we come in on the 27th. If you had not closed this deal, the 25 cents will go to the brokers or market makers at that time, and this is where the premium becomes zero. This money, unless you sell it and somebody else buy it, eventually be down to zero. So it's worthless. Right here, we show you a quick situation with the stock owner write a cover call contract, and the strike price is at 240, which what you saw over there with Apple on April 6th. You're looking exactly at the same, similar to it. So we go over here at part A and part B. If Friday 8, the stock going up and this like that, it gets over here where the option gonna expire. So the last trade is gonna be on May the 8th, which is gonna be on Friday right here. This is the same stock or a different stock where the price, the option price, the price of the premium is overlaid on the actual candlestick chart. So over here, the stock get about to 600, and then the price move up again, and it's still at 600. So you pay the premium, 240 for $500. The $500 here, so it's in the money, 0.33. 0.61, 0.41, and at the end of the day, the intrinsic value of the option is $1.41. The option extrinsic value is zero. What we're saying here that the option have both of them. You are in the money, you know, the last change, it was $241 on Friday the 8th. And what we got over here is that the option premium end up zero. So the option extrinsic value is at zero right here. And then all we are in the money from the option that it was 240 is 141. And that's all is left, $1.41 that is on the stock and nothing on the option. So right here, we already saw this before, how the premium go down and gradually reduce the value of the option premium. So hopefully they can explain and satisfy your questions in regard to trading options. Always remember that the option will lose value, the premium that you pay eventually end up at zero. And you have to take that in consideration because as time goes by, if the stock don't go fast enough up or you wait too long, you're gonna end up with a zero option, or you have the stock that you always can write another option. So you're an option writer, you are in the advantage. So this is the last part of the mechanic of part 2 for the options sharing, you know, and hopefully you